When executives consider where to locate or expand their Nordic operations, the comparison between Denmark and Sweden on corporate taxation quickly becomes a strategic question rather than a purely technical one. And understanding the nuances can meaningfully influence after-tax returns, governance choices, and long-term competitiveness. In this video, we will walk through the headline, Corporate Tax Rates, the effective tax burdens once deductions and incentives are considered, and the broader ecosystem of labor costs, innovation support, and administrative predictability that shape the real-world experience of operating in these two highly developed, relatively high-tax economies. Starting with the basics, Denmark currently applies a flat corporate income tax rate that is slightly lower than Sweden's, putting Danish companies at a modest advantage on headline statutory rate alone. However, in practice, the effective tax burden depends heavily on sector, capital intensity, and the extent to which companies can leverage deductions, interest limitation rules, and cross-border planning opportunities within the EU and Nordic region. Both Denmark and Sweden align closely with EU directives and OECD standards, but Denmark has pursued a relatively streamlined approach. The rules are concise, the authorities are accessible, and large companies routinely highlight the predictability and consistency of Danish tax administration as a differentiator. Sweden, for its part, has incrementally reduced its corporate tax rate over the years and offers a relatively broad deduction framework, but it also features complex interest limitation rules and a sometimes more granular interpretation of anti-avoidance legislation, which can require closer ongoing tax governance and stronger internal controls to avoid disputes. Moving beyond the headline rate, one critical dimension is the tax treatment of research and development, intellectual property, and high-value services, as many multinational groups now base key functions, risk, and assets in the Nordics to tap into strong talent pools and stable institutions. Denmark offers attractive R&D incentives, including enhanced deductions for qualifying expenditures and, for certain companies, the ability to receive a cash refund of negative corporate tax resulting from R&D deductions, which can be especially relevant for growth-stage technology and life science firms that are not yet profitable. Sweden also supports innovation through various measures, including deductions and social security contribution relief for key employees in R&D roles. But the Danish regime is often viewed as slightly more cash flow friendly for early-stage or highly innovative businesses because of its refund mechanism and the clarity with which the rules are administered. Another important factor is taxation of outbound dividends, royalties, and interest, which shapes how groups structure holding companies, financing vehicles, and IP ownership. Denmark is frequently used as a regional holding jurisdiction, benefiting from the EU Parent Subsidiary Directive, a broad treaty network, and domestic participation exemption rules for qualifying shareholdings, which together enable tax-efficient repatriation of profits from operating subsidiaries across Europe. Sweden offers comparable EU-driven advantages and its own participation exemption regime, but some multinational groups note that Denmark's combination of legal certainty, administrative guidance, and long-standing use as a holding platform has created a somewhat more mature ecosystem of advisors, banks, and legal structures specifically optimized for regional headquarters and holding activities. However, the corporate tax discussion cannot be decoupled from the broader cost structure, particularly labor taxation and social security contributions, as these directly affect the total cost of employing talent and, by extension, location decisions for shared service centers, R&D hubs, and regional headquarters. Denmark is known for relatively high personal income taxes, but also for a labor market model that combines flexibility in hiring and firing with strong social safety nets, financed partly through general taxation rather than employer-specific payroll charges. The net effect is that while employees face high marginal tax rates, employer-side social contributions, in many cases, are not as heavy as might be expected, given the breadth of public services. Sweden, in contrast, applies significant employer social security contributions on top of salaries, which can increase total employment costs, particularly for large workforces. At the same time, Sweden's overall personal income tax burden is competitive within the high-income country group, and the country offers specific reliefs for foreign experts and key employees that can mitigate costs in strategically important roles. From an investor's perspective, another relevant angle is how each country approaches tax disputes, audits, and the overall compliance burden. Denmark's tax authority has invested heavily in digitalization, pre-approval processes, and cooperative compliance models for large taxpayers, providing companies with relatively early certainty on complex structures and transactions, though this comes with an expectation of transparency and robust documentation. Sweden has also modernized its tax authority and is recognized internationally for professionalism and integrity. But some businesses report a more detailed, sometimes prolonged audit process in certain areas, such as transfer pricing and interest deductions, which can introduce additional administrative overhead and the need for proactive dispute management. Both countries, importantly, have fully embraced OECD base erosion and profit-shifting standards, meaning aggressive tax planning is increasingly difficult and reputationally risky. As a result, leading multinationals in both markets now emphasize substance, real economic activity, and transparent structures as the foundation of their tax strategies. When comparing Denmark and Sweden, it is also essential to consider stability and predictability over time. Both jurisdictions are politically stable, but Denmark is often cited for its relatively steady, incremental approach to tax reform and for engaging closely with business stakeholders before implementing changes, which supports long-term planning. Sweden likewise offers a high degree of predictability, though periodic adjustments to interest limitation rules, loss utilization, and specific anti-avoidance provisions have introduced episodes of uncertainty for highly leveraged or transaction-heavy groups. For many companies, the decision does not come down to a simple winner in the corporate tax face-off, but rather to which jurisdiction's mix of statutory rates, effective tax burden, labor cost structure, innovation incentives, and administrative environment best aligns with their business model. Organizations with strong R&D or IP-driven strategies may find Denmark's combination of R&D cash refunds, holding company strengths, and predictable corporate tax framework particularly compelling, especially when coupled with access to highly skilled English-speaking talent and a vibrant innovation ecosystem in Greater Copenhagen and other hubs. Firms that place a premium on access to a larger domestic market, deep industrial clusters, and long-standing manufacturing or engineering capabilities may lean towards Sweden, balancing its corporate tax features with its scale advantages and sector-specific ecosystems. In conclusion, when evaluating Denmark versus Sweden on corporate taxation, leadership teams should look well beyond the nominal tax rate and model scenario-based effective tax outcomes that incorporate R&D incentives, financing structures, labor costs, and expected dispute patterns over a 5 to 10-year horizon. By integrating tax analysis with broader strategic considerations around talent, infrastructure, and regulatory environment, companies can move from a narrow tax comparison to a holistic location decision that optimizes not only after-tax profitability, but also resilience, operational effectiveness, and long-term value creation in the Nordic region.